Hello, everybody. Let's predict the market's next move. Now, we know Jerome Powell, he's thinking hard about the decision he has to make and what he has to say. Is he going to be a hawk and then all of a sudden after the meeting watch markets completely tank? Or is he going to wiggle himself out of it and make it look like everything's okay and it'll be a softish landing and the markets will pump and thrive? You're watching the Stock Market Brief Show. My name is Michael Silva. We got a lot to talk about, but it's going to be a condensed show today. Let's get into it. All right, everybody, welcome back to the show. Jerome Powell, he is coming up tomorrow at 7 a.m. That is Pacific Standard Time. Also to note, we have some other big market events. We have personal income month over month. We have personal spending coming out. That's an hour before the market open. Okay, so that can also get the markets moving. After that, and the Jerome Powell speech, we also have Michigan consumer sentiment. So we got a lot of stuff going on tomorrow. What took place in the markets today? Well, we hit the edge of that expected move that we discussed yesterday. On yesterday's video, the market did rip higher today, getting outside of all this open interest that was building. Let's zoom in a little bit here and take a look at the 5-minute time frame. So all week, this orange line here is the weekly expected move. All week, we've been just chopping around there. Now, I sent this chart off to some of the Patreon viewers early on, probably right around this point, I think it was. I was basically saying, like, it looks pretty bullish for the most part. I even sent it actually when it was coming up to the 5-day. And this is the 5-day moving average, just so you know. So it's a declining 5-day moving average. Price came up. It broke out of these previous highs. Bam, that was kind of what we discussed on yesterday's show. Like, if it breaks this right here, we can see it pop up to the 5-day moving average. It came back and back tested it, then kind of skirted it. Something that I noticed early on, though, was this undercut. Now, when you get an undercut like this, it was kind of a tell. And if you see this moving forward, maybe it can help you intraday trading. But we had this little flush point. So anybody that had stop losses, around this point, they quickly got flushed out, or people that were potentially shorting down through this had to cover as price came back, creating this little bit of a rally right back into that declining 5-day moving average. And then we had that price just really consolidate sideways, and it wasn't up until we got through that 417 and then 418 we started squeezing significantly higher, okay? Now we have still this gap above us right at around 422, which is more than possible to hit. In today's episode, we will talk about some predicted ranges, expected moves. We're going to look at big picture. Then we're going to zoom in. The dollar right now, the dollar is just consolidating sideways. It hasn't really broken down. We have some people like David Hunter coming out saying that he believes it to be a double top. It's not a double top until it takes out that 105. Then we can call that a double top. As it stands right now, there is a negative divergence building, but also you can look at this, higher highs, higher lows, and right now it's just consolidating, right? You can say this is just a little cupping pattern, and it's just building out a handle before a potential breakout, okay? So that is how I see it personally right now. Still in bullish conditions, but it is digesting its last week's move, which is obviously gigantic. Let's look at some predicted ranges and expected moves. What is the difference? The difference is this. They're both have to do with volatility. One is historic volatility, okay? Measure mapping, basically the average true range. I'm not going to get into the calculation here, but I'll share you what it looks like. And then the expected moves is coming from the options market. It's implied volatility, okay? It's what the market is depicting as risk looking forward, okay? And we're going to show you both of those, starting with the SPY. The gray box is the implied volatility for the SPY. So the expected move is going up to around 425 tomorrow to the downside, which is, guess what? Right by, again, the lower weekly expected move. So to me, unless if some exogenous sort of talk comes out of Jay Powell's mouth, it looks like it's going to be closing in within that weekly expected move that we pointed out on the very beginning of the week, or going into this week. Now, this orange box, that is based off of historic volatility looking backwards. It's using the average true range. It's a specific calculation I'm not going to get into in this episode, but that is pricing into just around 422.50 to down here to around 417. All right, so I like looking at both of these just to give an idea as potentially levels to watch. Now, we had a big, strong move outside of this weekly expected move, so if we gap up, it could perpetuate itself potentially up further into this range, and that's where we could potentially see it start to topping out. So you can play potentially a gap and go. But also be mindful that if we gap down and Jerome Powell talks and it's bearish, start looking at down here if you're playing short to potentially cover, okay? So we're looking at quite a large range, a lot of volatility going into tomorrow's move. Let's look at the Qs here. The Qs also close at the high of the day. We're looking at the low end right at around 315 and some change to the high end right about 326. That is the EM. That is the expected move going into the Jackson Hole Fed talk, okay? And this also includes, right? This also includes all of those other reports that we're going to be getting. The orange box is this is volatility based off the historic volatility, and we're looking at 318 to around 323. So the same story goes as we previously discussed on the SPY. If you look at the IWM, quite a large range here too. Hasn't tagged the lower range, and it hasn't tagged the upper for the week, so we're just contracting within it. Big, strong day-to-day moving outside of these 3 candles, okay? And now it's basically saying we're right at around 199 as far as the expected move goes to as low as 192, okay? And then as far as ATR goes, or the predicted range, it's looking at around 194 to around 197. So those are the levels. Those are the areas to give you an idea. If we're looking at just the orange boxes are saying, hey, it looks like we can have a higher high, higher low, okay? But if you look at implied volatility, it's saying, hey, watch out. It can be a very wild and wicked day. I want to look into some big picture things here to just give you context from a larger level. Then we're going to zoom in a little bit and then look at some indicators. From a larger level, I wanted to just reiterate this chart for those that may have not have seen it. Now, there's blue arrows and there's pink circles. This is a quarterly chart. So every candle represents a quarter. Okay, so we're about to, end this quarter and start a new one, but that'll be in September. So this candle's still going. Now, when the blue arrows, they highlight when we had since 2009, since 2010, when we've had a quarterly close beneath the 5-period EMA, the quarterly 5 EMA. Okay, now remember that, right? That's important. Boom, we had a close below it. Boom, 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 boom. And then right here, we're just recently had one, okay? Now we're having a new quarter. The reason why I'm pointing this out is because every time we had a quarterly close below that 5 EMA, the Fed stepped in, okay? So we had QE, 1, 2, we had, we had the COVID where the Fed stepped in doing unlimited QE. We had some China stock market turbulence. Over here, this was the repo crisis, right? So we have every single one of these, the Fed stepped in and did something. Now, the reason why I'm pointing that out now is because we are below the 5 EMA and the Fed is still in a tightening cycle. Okay, if you've actually been paying even closer attention up around these areas, guess what? Is when Fed members started dropping off because people were calling them out for trading the market, right? And benefiting a lot from these large increase in quantitative easing over here. Okay, now that's when it closes one time beneath it. And we're right there on the 5 EMA. But what happens if we close twice beneath it? Well, the only times that I can point out here, and I can also go back through history, and I've seen it a few times too, but I don't have that chart with me right now, and I'd have to do a little bit more work on the Fed stuff. But these are two instances where we'd have 2 EMA closes or 2 candle quarterly closes below that EMA. So it was right here in the dot-com bust, and then right here leading into the financial crisis as well. Okay, if we zoom in a little bit further to the S&P 500 on the quarterly time frame, you can see this solid line going across the screen. That is the monthly expected move for August. We tagged it just about, then we started getting off. The dashed lines is the quarterly expected move for this quarter. And you can see we got outside of it, but we're currently trading within it as it stands. And then we're right by that 5 EMA. Now, I want to show you something. I know a lot of people don't like using analogs, and that's totally fine. I actually understand why, because it could just be noise. We are living in a different time, but the understanding, the psychology when we see these rallies and then going back through history to see how that may have been similar, it's important to note that stuff. And if we look at the S&P 500 here, this is the quarterly candles, the quarterly chart leading up to the financial crisis where we had that quarterly close, and then we saw this big move, right? Distinguish the difference here. We had a big rip, right? We had that quarterly close, boom, 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 2008, now 2008, now 2008. But guess what? This quarterly candle, that was in August, okay, going into September, which is what we're doing right now. And how did this candle actually close? That's important to note. The candle actually closed like this. We saw some wicked sell-side activity, and that's what really sent the markets in kind of a just tailspin to the downside, okay? So not to say that this is going to happen, but it's also important to note that, hey, we have one more month left in this quarter, and a lot of things could very well happen, and we just got to be on guard. We just got to be prepared, right? The Fed is tightening. Despite what we saw today in the Fed balance sheet, kind of lifted up slightly today, but that's kind of how it works. It ebbs and flows. So chances are the next report will probably see it down. Let's zoom in now because I'm already kind of going over what I wanted to go over as far as time goes. You can see here we have a little bit of a gap, right? We're back above that 5-day moving average. It's still pointing down for the most part as it stands right now. The longer we stay above it, it'll start going back to neutral, maybe potentially give us some sort of entry point if we are wanting to get long. But as it stands right now, it was a huge move. RSI is getting a little bit burnt up right now. So yeah, if we come up here in a very straight shot, that could be a potential fade opportunity, or you just got to be patient for these levels to kind of work themselves out and potentially do something like that to the upside. But as it stands right now, yeah, you got to be patient, right? Remember, markets move between contraction and expansion. Contraction and expansion. Tomorrow it's going to be a volatile day, so we might not get much contraction. Maybe the only contraction that we'll get is leading up to Jerome Powell's speak. Okay, if we take a look at the Qs back above that 5-day moving average, still declining at this point. You can see it acted as resistance, then we kind of floated around it, all right? And then you can see it's still declining, but the longer we stay above it, it'll start neutralizing itself, then potentially go to a more bullish stance. If we take a look at the IWM on the 15-minute time frame, subtle negative divergence that's forming right here. You can see high, lower high on the RSI, high, a little bit higher high right here, and that could potentially play out. Now, this is something that we drew yesterday. We talked about potential shorting down through 192 to the lower weekly expected move. That never came, but we did break out to the upside, and what happened? Well, it came down, boom, and then I was looking at something like that where we can play it to the upside, but we didn't actually quite get it, and now the move already, it was a pretty large move up into that area, and RSI is getting a little bit burnt up, so you got to be patient here. I don't plan on trading tomorrow at all, mainly because I'm going to be heading out camping for the weekend, but I will have my gear with me, surprisingly enough. I'll have Starlink access, so I'll probably make a video out there while I'm camping and doing stuff out there. Let's take a look at a couple indicators. I'm going to start with some zones. If you don't know what these are, it is what it is. This is something that I share with the Patreon community. This right here is really just neutralizing itself, okay? You can see 3.4% upside, 3% downside. We're right there in the middle of the zone, okay? So it's very binary. We're leading into a binary event. It can go up, it can go down. There's not really a big skew. And what do I mean by a big skew here as far as there's direction to the upside here, right? Things are overextended to the downside. Well, if you remember just a few days ago, which you can see here, if you remember watching at the end of the video, of like a video or two ago, we talked about ARK, and ARK, it was basically showing this. It showed minimal downside, but a huge upside, meaning that it was getting overextended, right? These helps you determine risk and reward. Even S&P 500 at the time said, a little bit more minimal downside, right? And then 5.35% to the upside. So it just, everything, down the book here looked overextended to the downside, and things looked like they were about to get ready to perk up, which is why we always talk about don't shorten the hole. Well, if you remember now, or if you look now, ARK, right now the downside is the upside is minimizing, and now the downside is growing again. Why? Because we're back there in the middle of the zone, okay? So yeah, like I said, binary. Now from the summation point of view, we're looking at the NASDAQ summation index, and I put a parabolic SAR underneath it because it can help catch trends, and it lasts typically for a while. You can see here we have now 3 dots above us. We're starting to move up today, but the trend could be potentially changing here despite even seeing this bullish. Now, until this clicks back down is when we could feel a little bit more confident. The fact that it's back above zero is bullish in itself, but be mindful that, hey, if the trend wants to continue down, it could head right back down too. So what we want to see is, that, and then all of a sudden this to start clicking back up to give us a little bit more confidence in that. Now, if we continue on to the final chart of the show, I want to look at the summation index for the New York Stock Exchange. It's a more broader index. We talked about it getting overextended to the downside. Once again, the bounce seemed almost inevitable at this point. So that's why I'm saying it seems like it was just covering, right? Now we're going into Jackson Hole. We're more neutral right now, and it's very binary. So you got to be careful. That's what it comes down to. You can be very tactical on the intraday charts, but I wouldn't be making huge financial decisions here, given that Jerome Powell could come and he can be incredibly hawkish, or he can work his magic, and all of a sudden we see it rip to those upper expected moves. The summation index as it stands right now, 3 dots above. Okay, so the trend has shifted here in the last 3 trading days. What we want to see is this to turn back around. It is above zero. So once again, that is actually a bullish indication in its first place, and it could just very well be digesting for another move higher, but that's not what has happened yet. That's all I got for you on today's episode, everybody. Have a wonderful night.